What are REITs and how to invest in them? If you're looking to enter the real estate market as an investor but don't wish to get directly involved in property ownership as a landlord, then real estate investment trusts, REITs, could be a good option for you. With a number of different types of REITs available for investing, you'll find the right opportunity for your investment portfolio. This episode will cover the 5 types of REITs and how to invest in them. We'll also take a look at the advantages and disadvantages of REITs. But before we go too far, don't forget to hit that subscribe button so you don't miss the next videos about real estate investing and the best REITs to invest in. What's a REIT? Real Estate Investment Trust. A real estate investment trust, REIT, is a company that owns, operates or finances income-producing real estate. REITs provide an investment opportunity, like a mutual fund, that makes it possible for everybody, not just Wall Street banks and hedge funds, to benefit from valuable real estate, present the opportunity to access dividend-based income and total returns, and help communities grow, thrive and revitalize. REITs allow anyone to invest in portfolios of real estate assets the same way they invest in other industries, through the purchase of individual company stock or through a mutual fund or exchange-traded fund, ETF. The stockholders of a REIT earn a share of the income produced, without actually having to go out and buy, manage or finance property. Many people live in households invested in REITs through their 401k, IRAs, pension plans and other investment funds. Why should I invest in REITs? REITs are total return investments. They typically provide high dividends plus the potential for moderate long-term capital appreciation. Long-term total returns of REIT stocks tend to be similar to those of value stocks and more than the returns of lower-risk bonds. Because of the strong dividend income REITs provide, they're an important investment both for retirement savers and for retirees who require a continuing income stream to meet their living expenses. REITs dividends are substantial because they're required to distribute at least 90% of their taxable income to their shareholders annually. Their dividends are fueled by the stable stream of contractual rent paid by the tenants of their properties. The relatively low correlation of listed REIT stock returns with the returns of other equities and fixed income investments also make REITs a good portfolio diversifier. REIT returns tend to zig when those of other investments zag, helping to produce a portfolio's overall volatility and improve its returns for a given level of risk. Now, let's take a look at the 5 types of REITs and how to invest in them. 1. Retail REITs. Retail REITs are a type of REIT that owns and manages retail properties in central business districts and upmarket areas. It leases the retail space to tenants looking to set up shopping malls, grocery stores, boutiques, etc. Retail REITs make money by leasing space to tenants who pay monthly, quarterly, or annual rent to the REIT company. Retail properties are attractive investments, and they are the single largest category of investments in most countries. When developing retail properties, most real estate properties focus on getting the strongest possible anchor tenant to become the first tenant in the building. Anchor tenants are often associated with prestige. Name recognition is a major attraction to customer and tenants, which may be a department store, retail chain store, or an improvement store. A retail REIT can also purchase struggling retail properties such as shopping malls with the hope of turning them around and attracting desirable tenants who can meet their monthly rental obligations. Some retail REITs may include shopping malls, big box stores, drugstores, outlet centers, service centers, grocery shopping centers, boutiques, home improvement stores. 2. Residential REIT. A residential REIT is a real estate investment trust that owns and operates rental property. Some own apartment buildings and some specialize in a type like urban high-rise apartment buildings. Others focus on a specific group of people like students. Some own single-family rentals. Some residential REITs primarily grow through development, that is, by building new properties from the ground up. Others choose to grow through acquisitions. They create value by purchasing and often improving existing properties. Some REITs do a combination of these. Residential REITs include REITs that specialize in apartment buildings, student housing, manufactured homes, and single-family homes. Within those market segments, some residential REITs also focus on specific geographical markets or classes of properties. 3. Healthcare REITs. Healthcare real estate investment trusts, REITs, invest in a variety of property types such as assisted living, hospitals, and surgery centers. The operators in these properties are providing services that won't be going away. This makes healthcare REITs one of the most attractive for long-term growth. It's important to consider the changes in the healthcare industry when you're looking for a healthcare REIT to invest in. Pay close attention to the types of properties they invest in, the services that are provided within the real estate, and the strength of the operators. You also want a healthcare REIT that's ready and able to make new investments as opportunities arise. The healthcare industry is changing, so REITs have to be able to move quickly with it. Healthcare REITs property types include senior living facilities, hospitals, medical office buildings, and skilled nursing facilities. 4. Office REITs. Office rates are rates that build, manage and maintain office buildings, and they lease the offices to companies that need space to accommodate their employees. While there are companies that own the buildings where they operate from, most companies turn to office REITs that specialize in leasing office space in central business districts and suburban areas. The office buildings can range from skyscrapers to office parks, and the REITs focusing on leasing to specific classes of tenants such as multinational corporations, NGOs, technology firms, banks, law firms, fintech companies, biotech firms, government agencies, etc. Office REITs trade their shares on the public exchange markets, and investors can buy REIT shares. 5. Mortgage REITs. Mortgage REITs provide financing for real estate by buying or originating mortgages and mortgage-backed securities, and then earning income from the interest on these investments. Some mortgage REITs focus on residential mortgages and mortgage-backed securities, while others focus on commercial mortgages and mortgage-backed securities. There are also mortgage REITs that hold both residential and commercial mortgages. When you invest in a mortgage REIT, you buy shares of that REIT, just as you purchase shares of a company's stock. What are the risks of REITs? The risk of REITs include lack of liquidity. Non-traded REITs are illiquid investments. They generally cannot be sold readily on the open market. If you need to sell an asset to raise money quickly, you may not be able to do so with shares of a non-traded REIT. Share value transparency. While the market price of a publicly traded REIT is readily accessible, it can be difficult to determine the value of a share of a non-traded REIT. Non-traded REITs typically do not provide an estimate of their value per share until 18 months after their offering closes. This may be years after you made your investment. As a result, for a significant time period, you may be unable to assess the value of your non-traded REIT investment and its volatility. Distributions may be paid from offering proceeds and borrowings. Investors may be attracted to non-traded REITs by their relatively high dividend yields compared to those of publicly traded REITs. Unlike publicly traded REITs, however, non-traded REITs frequently pay distributions in excess of their funds from operations. To do so, they may use offering proceeds and borrowings. This practice, which is typically not used by publicly traded REITs, reduces the value of the shares and the cash available to the company to purchase additional assets. Conflicts of interest. Non-traded REITs typically have an external manager instead of their own employees. This can lead to potential conflicts of interest with shareholders. For example, the REIT may pay the external manager significant fees based on the amount of property acquisitions and assets under management. These fee incentives may not necessarily align with the interests of shareholders. Like all investments, a REIT investment opportunity carries its fair share of risk, but one thing REITs don't have is the responsibility of being a landlord and with properties to manage. Savvy REIT investors will keep an eye on the markets in a variety of industries to determine the best ones to invest in for their risk tolerance. That's it for this episode. Please give us your feedback in the comment section below. To watch more episodes on financial topics like this, hit that like and subscribe button. If you want to support us even more, buy us a coffee from the link in the description. Good luck and see you in the next episode.